Hello everyone, welcome again to AM Finance Academy. So today we will come to that topic. That means I am resuming that topic. In the previous topic, I have told you about the capital structure, especially, and I am coming back to that topic. That means the factor affecting capital structure. So before coming to my topic, I can say that सो वॉच द वीडियो टिल एंड पूरा लास्ट तक वीडियो देखिए. बहुत अच्छा वीडियो है एक्चुअली. कैपिटल स्ट्रक्चर इज वेरी इंपॉर्टेंट फॉर योर फ्यूचर. व्हेन यू विल बी गोइंग फॉर एनी इंटरव्यू you may face this type of questions. The recruiter may ask you this type of questions specially, like what is capital structure, what is debt, what is equity, what is the difference between preference shareholder, what is the difference between equity shareholder and preference shareholder, difference between debenture and bond, something like that, the difference between equity and debt. All these things you may be asked in the interview while you are going to appear a finance interview. Okay, told you what is capital structure, the relationship between equity and debt, you can say. So the finance manager has to keep such a balance between the equity and debt so that the cost of capital will be minimum and the profit will be maximum. So because as I told you in the previous video, like the risk of equity and debt, or the cost of equity and cost of debt. Cost of equity is dividend, and while cost of debt is interest. So cost of equity plus cost of debt is equal to cost of capital. Suppose, just take this, like, so just look at this. So cost of capital, suppose it is KC, assume it is KC. Cost of equity is KE and cost of debt is KD. That means KC is equal to KE plus KD. That means cost of capital is equal to cost of equity plus cost of debt. That means cost of capital is nothing, it is dividend plus interest. The dividend we are paying to the shareholders, and the interest or the fixed charges that we are giving to either to the banks from which we are taking loan, or we are giving to the debenture holders or something like that. So this is all about capital structure. So what are the factors that is affecting capital structure, or you can say that those are the determinants of capital structure. The first one is nature, place, or the product of the business. Yes or no? So age means how much years the business is running. That means how old that business is into our society, or into our, especially what we can say, in India or in the world. Okay, nature, which type of product it is producing, from which industry it is coming, what is the demand of that product in the market, or something like that. It is nature. And place, where it is situated, especially is there any good transportation facilities there or not, or something like that. Okay, the second one is financial leverage. Third one is operating leverage. Actually, I will elaborating financial leverage and operating leverage in the next video, especially because this is a very important subject, and you have to go thoroughly into this type of topic, especially because it is very important to know about financial leverage and what operating leverage. Especially the leverage associated with the financing activities is financing leverage, and the leverage associated with the operating activities, that is operating leverage. But the most detail we will go into the next video. So this financial leverage and operating leverage also determines the capital structure. That means it has an effect on capital structure. How we will know it on the next video. Okay, so the next one is competitive parity. So what is competitive parity? Competitive means there must be competition, and parity means we can say competitive parity is nothing but comparison of equity ratio from your company with the another company having same products or same type of business. Like suppose you are doing a business, you have to compare with your equity ratio with another company who is having same type of business like you. So this is the comparison of equity ratio with your company with the same type of business. Okay, so the next one is exposure of the company. Exposure of the company means how much exposed the company is to. That means how much the company is exposed to public, especially what is the public's perception towards this company, what is the goodwill, what is the brand value. All these things will come under especially exposure of the company, especially. So these 5 things, especially whatever I have said, you like exposure of the company, age, nature, place, or product of the business, financial leverage, operating leverage, and what we can say that competitive parity. So all these things will be things are the determinants of the capital structure. So I am not elaborating all these things because these are not so important, because by taking some assumptions we are considering all these theories like net income theory, net operating income theory, or net income approach, net operating income approach, traditional approach, and approach. Okay, so especially the objective, why we are considering all these theories, specially nothing but actually maximizing the value. The main objective of reading these theories is to know the relationship between cost of debt, cost of equity, and weighted average cost of capital. What is weighted average cost of capital? That is nothing but the cost of the capital. Like WACC. Okay, so now look at this. So here it is the cost of equity plus cost of debt is equal to cost of capital, or we can otherwise say this is as cost to business also, because business has to pay this cost. So this is otherwise known as cost to business. Cost of equity is KE, cost of debt is KD, and cost of capital is KC. Okay, so what is weighted average cost of capital? Let us elaborate these things by giving an example. Suppose we are paying interest to the outsiders, that is 5 lakhs. Okay, that is cost of debt, or KD. We are paying dividend to the shareholders or to our owners, we can say that is 7 lakhs. That is cost of equity, or KE. Okay, so if we'll add both of them, we'll get WACC, or weighted average cost of capital. Okay, so that is 12 lakhs. 7 lakhs plus 5 lakhs is 12 lakhs. Okay, suppose we will have net profit 15 lakhs. From 15 lakhs we are paying 12 lakhs. That means this is cost to us, yes or no? So from 15 lakhs profit we are giving 12 lakhs dividend to the equity shareholders, or interest to the outsiders. So rest of how many we have remaining? That means we have remaining 3 lakhs in our hand. So this remaining amount will be kept as retained earning, or reserve and surplus to meet future contingencies, we can say. So are you getting this? So weighted average cost of capital is nothing but 5 lakh plus 7 lakh is 12 lakhs. That means cost of debt plus cost of equity is weighted average cost of capital. Here, so what is capital structure? It means we have said you the combination of all long-term sources of finance. Sources of finance also I have said you, it includes equity share capital. Equity shares of capital also I have said you, that is the owner's capital. Like when owners are investing their own money into their business, that is equity share capital. This is insider's fund. Reserves and surplus, this is another term. This is also a very important term that is asked during maximum interview. So I will explain it later. So this is nothing but for the current time I am saying you, reserve surplus is nothing but it is a part of profit that is kept to meet future contingencies. If something will happen in the business or some loss will happen, reserve and surplus are kept to meet that. Preferential capital. Preferential capital is, what is the difference between equity share capital and preferential capital? I am saying you here. So preferential capital is nothing. It is a share capital that is giving, that is, we are giving, our business is giving more importance. That means when making payment to the outsiders, after making payment to the outsiders, before giving to equity shareholders, we have to give the payment to the preference shareholder. Like equity shareholders, they are not the owner of the business. Preference shareholders are not owner of the business. So only we have to give them preference over the equity share capital. That means we have to make them payment fast before giving payment to the equity shareholder, and we have to give them also a fixed dividend. Like equity shareholder, equity shareholders are not receiving the fixed dividend. Actually their dividend depends upon the profit and loss of the company, but we are talking about the preference share. So preference shareholder, actually they are taking the fixed dividend, like as per the agreement. Okay, so they do not have, also I can say they don't have much rights as equity share holders have right on the business. So they do not have, but later we can convert them. Actually there are a lot of types of preference shares are also there. So I will explain you in the another video, because it will take a very long time also. So like convertible, non-convertible, so this type of preference are existing. So here we can say preference share capital is the capital of a preference shareholder. Okay, then loan, like we are taking loan from bank or any financial institutions. Debentures, I have debentures. What is debentures and what is the difference between loans and debenture? Why company is issuing debenture? Actually debenture is nothing, it is a loan like things. Like when we are taking loan from bank, like that company is actually issuing debenture bond, like it is issuing debenture to the public and it is taking money from them. So it is a document, like it issued a document to the public for which public is giving money to the business and business is giving them some fixed rate of interest for a particular period of time. So when company has raising money by issuing debentures bond to the public, okay, and having a fixed period of time and having a fixed rate of interest, that is known as debenture. Okay, it's a deposit, you can say. Okay, public are depositing their money into the business for which they are receiving a fixed amount of interest and other such long-term sources of finances. Okay, so a company has to decide the proportion in which it should have its own finance, outside, especially outside finance, that is debt finance. Okay, I have said you capital structure is nothing but it is the combination of equity and debt. The proportion of equity and debt, the financial manager has to keep the balance between equity and debt in such a way so that the cost of capital will be minimum. That means, so based on the proportion of the finance, WACC, that is weighted average cost of capital. There is nothing. Capital structure theories are there like net income, net operating income towards capital structure theory, because those theories are taking only assumptions, like theories based on certain assumptions like cost of debt should be less than cost of equity, there are no corporate tax, risk perception of investors remains unchanged. So these are not practical actually. So these theories have also limitation. So while you are going to attend some interviews also, they will not ask as I am feeling. So I am not giving full elaboration of these capital structure theories. So actually basic purpose behind this theory is to maximize the value of the firm, to minimize the cost of the capital, to understand the relationship between the equity and debt, and to understand the relationship between weighted average cost of capital, value, cost of equity and cost of debt. So this is all about all these things. Like in traditional approach, what is the effect if WCC increases, value decreases, or cost of equity rises, then what will happen? So in the traditional approach, in the net income approach, first priority is to maximize the value. That means what is the value here? The value is equal to EBIT by KC. EBIT is the earning before interest and tax, and KC is the cost of capital. Okay. In the net operating income approach, it is opposite to the net income approach especially. So I am not saying you much about this capital structure theory. Okay, so I will make a very important video in the next topic, that is leverage. It is a very important topic, so please watch this video, what is leverage, because you will be especially maximum finance freshers are facing this type of question, like what is leverage, what is financial leverage, what is operating leverage, what is combined leverage, what is the difference between all these things. Okay, so I'll make this video very soon. Okay, so everyone, I think actually these are all the theory parts. Okay, so you have to know it, because why I'm making this video always often and often, I think you must be getting bored about things, but I want to make a complete section here. So just see it. I'll make so much important videos when I'm making the next video, especially about interview questions and how to answer all these questions also. So before that, just stick to this video, understand it simply. This is I know these are the theory parts, so especially you may getting bored or something like that, but you have to know it. Okay, so if you are liking my video, अगर आपको ये वीडियो अच्छा लगा है तो पूरा फुल वीडियो देखिए, सब्सक्राइब कीजिए, याद से सब्सक्राइब कीजिए, मत भूलिए सब्सक्राइब करने के लिए, लाइक कीजिए, शेयर कीजिए, जितना आपका दोस्त है और कोई है उसको ज़रूरत है वीडियो तो शेयर कीजिए. थैंक यू.